Carvana is an interesting company to evaluate. The company operates in the used car market, and it only has a 1% market share of a massive market opportunity. The used car market is also incredibly inefficient, where companies like Carvana and CarMax can come in, add that efficiency of information that assuages some buyers from buying used cars. But all that being said, should long-term investors buy Carvana stock today? I'll answer that question in this video. I'll look at the company's revenue growth, its profit margins, its returns on invested capital. I'll talk about recent strategic missteps that cost the company significantly in the aftermath of the pandemic. And then I'll look at valuation on a forward price to earnings basis, and I'll share with you my proprietary discounted cash flow valuation for Carvana, let you know what I think a fair value is for this growing used car stock. So let's jump in.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so in the last 3 years, Carvana's market cap has exploded higher, right? Its market cap had collapsed all the way down into the hundreds of millions of dollars as the company made some strategic missteps in the aftermath of the pandemic. If you don't recall, during the pandemic, we had this situation where used car prices soared higher. And sometimes people were getting quotes like I did for a car they bought several years before at a higher price than they paid for that car. For example, I had a 2017 Honda Accord, which I bought around that same year. And then during the pandemic, around 2022, when I was shopping for an SUV, I got a quote to repurchase my Honda Accord at a higher price than I paid for it, even though I had put tens of thousands of miles on the car, which is rare. It's unheard of, right? That you have a used car price higher than what you paid for it. It's usually the opposite. As soon as you take a car off the new dealership lot, the value depreciates almost instantly. So Carvana is in the market of buying and selling used cars, and so it ended up buying many used cars at those higher valuations during those unprecedented circumstances during the pandemic. And then when the market corrected, used car prices fell, and Carvana was on the hook for all of those cars that it paid high prices for. So that unique circumstance really cost Carvana, and the company was in dire financial circumstances. It was at risk of going out of business at one point. And so it's recovered from that, and you've seen that in the valuation where the valuation has soared from the hundreds of millions to now up to $28 billion. And you can see that in its revenue growth where it turned negative for several consecutive quarters, but has since re-accelerated and returned up to 42% revenue growth in the most recent quarter. In the most recent quarter, the company reported sales of 114,000 vehicles, which was up 50% from the same time the prior year. The company's operating income reached a record $990 million for the full year in 2024. So they have solidly turned things around from those major missteps during those unprecedented circumstances as a result of the pandemic. And looking out more broadly, as I highlighted, they only own roughly 1% of the used car market, and those expectations are that it will increase its market share, and I wouldn't be surprised if it does. Now, I talked about the inefficiencies of the used car market. Now, as a graduate student of economics, one of the concepts we learned about a lot during my graduate studies is the inefficiency of the used car market. And it's an interesting market to consider because there's a interesting dynamic there where people, if they have a good car and it's going well, and let's say it's like 7 years old and it's working well, it's not giving you any trouble, you're not likely to put that car on the market for sale, right? Because it's working well for you, it's giving you good mileage, and you're not having to spend too much on maintenance. On the flip side, if you have a used car that's giving you all kinds of trouble, you're more likely to put that used car on the market. And so from the other side is, if you're a buyer, you know that fact. You know that fact that used car sellers are more likely to sell their car if there's something wrong with it. And as a buyer, you may not be a mechanic and you may not be able to find what's wrong with the car in that moment. So because buyers are on a side where there's asymmetric information, the sellers have more information than the buyers do, they're at a disadvantage, right? So that's where there's an opportunity for companies like Carvana and CarMax to step in and close that gap of asymmetric information, have a reputable seller that provides assurances to buyers that they're not buying a lemon. And so that's why I'm optimistic about the market opportunities for Carvana and CarMax. Both of them, I think, have a great opportunity to take market share away from all of the other used car sellers in the market. It's a fragmented industry, and there's an opportunity for them to gain significant market share. We talked about the record margins in the most recent quarter, in the most recent year, and Carvana's operating margin is up to 7.25%, up very nicely in the last decade from negative 25%. However, in the longer term, I'm not too optimistic about Carvana's ability to generate strong profit margins or returns on investor capital, because buying and selling used cars is a very capital intensive endeavor, and it's not what I like to see in the business. It's the opposite of what I like to see in a business model, which you've heard me talk about. I like asset light business models. This is a very asset heavy business model. You're buying used cars for tens of thousands of dollars and then hoping to turn around and sell them for a small profit. You're not going to generate a 50 or 75% margin on the purchase and sale of a used car. It's not like you're going to buy a used car for $20,000 and then turn around and sell it for $30,000, right? There's too much information in the market from buyers who have other choices in where they can buy a vehicle. And so they're not going to overpay for a used vehicle by that large a margin. So for that reason, I don't, even though I'm optimistic about the company's growth in terms of revenue, I'm not optimistic about the company's growth in terms of expanding the margins. And a similar idea with the return on investor capital. It's only 3.5%. It's improving nicely, but I think there's going to be a limit to this return on investor capital. I don't think there's very much likelihood that the company can expand this return on investor capital beyond 20% at the very large economies in scale if it were to reach those expectations of growing its market share from 1% to 10%. And so now let's look at valuation. And when I did my discounted cash flow calculation for Carvana, my intrinsic value per share came to $103. That's less than half the current market price at $213. The main reason is the company is very risky still. It has a beta of 3.57, which might need to be adjusted lower. So I did a scenario where I did lower that beta from 3.6 all the way down to 2, but that still only increased the price to $166. So the intrinsic value compared to the market price signals that it's overvalued. And then when I measure it by the forward price to earnings ratio, it's trading at 3 times that of CarMax, which is trading at a forward PE of 14. Carvana is trading at a forward PE of 43. A forward PE of 43 seems relatively high for a business that has very high capital intensity like Carvana does, relatively low margin potential. So looking at the valuations, it looks expensive at current prices, even though longer term I like its prospects to gain market share. So to answer the question, do I think the stock is a buy, hold, or a sell? I think at current prices, the stock is just a hold, not a buy. And I updated that recommendation today, March 24th. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.